topics for today because it's always nice to have a little jam for today. But I'm gonna reveal the secrecy underneath slowly because you can also spot that we're having the ADP non-farm employment change. The numbers will be out in about 10 minutes, maybe a little bit longer, because as you already know, my time here on this particular PC is a little bit different from other people's. Yeah, it's very special. I know, I like special stuff. However, we're going to discuss. I don't like that empty chair in the Maxis, please. Come back to us. I know you miss us. We're going to discuss the community forecast because it's Wednesday, and you know that our team is posting it exactly the night before. And next up, we'll have the economic data release, market research, and of course the technical analysis. So I would love to invite Kate on the whiteboard and listen who was the most precise forecaster of this week, please.
Hello guys, once again, thank you Paulina so much. So today I'm going to cover a community forecast for the euro-dollar currency pair, while the full analysis you could find on our website. Concerning the most trading pair during the previous week, the euro-dollar continued its mixed trend by falling below the 1.11 point back on Friday. Also, the dollar was spurred down after Federal Reserve Chair Janet Yellen indicated that she still expects interest rates to rise later this year, and as USA's second quarter growth was revised higher. Meanwhile, second quarter US gross domestic product growth was revised from 3.7% to a final annualized rate of 3.9%. By the way, larger gains in consumer spending and commercial and residential construction drove the upward revision. Still, last week's decline of the pair has already started on Wednesday, as sentiment on the greenback was fragile ahead of a speech by Federal Reserve Chair Janet Yellen. However, this week's sentiment has improved significantly, as almost 63% of participants in our weekly quiz expect the euro to rebound. In the course of the working week, analysts are waiting for a big portion of data, and some data will be released today. It includes a report on the trade balance and consumer sentiment, also revised data on second quarter growth, as well as initial jobless claims data and data on manufacturing activity from the Institute of Supply Management. By the way, average prediction for the euro-dollar soared to the 1.14 major level, while the pair closed at 1.12 back on Friday. As Kalinamasa suggests, the euro-dollar still supported last week around 1 point level, as it slightly recovered towards 1.12. So 1 point level will be minor support this week, which may send the pair towards 1.14. If USA employment was not good for dollar, but new surge in the USA employment data or lower unemployment rate should give a boost for the dollar, especially after Yellen's last speech. By the way, the same positive outlook is assumed by another trader, which adds that he has a bullish view on the pair, but he thinks it will retest the bottom of the 7-month channel before hitting back up. Well, that's all, by the way, from my side. Also, of course, the Dukascopy team would like to thank all the participants who have taken part in our community forecast, and also the analysis for additional pairs for dollar pound and dollar yen you can find on our website. And that's all from my side. Thank you guys once again for listening. I hope it was quite useful for you. And now I give the floor back to you, Paulina.
Thank you very much, Kate. And when you were saying a gazillion thank you to our Dukascopy community members, our clients who are very active each week, and they provide their projections for us, because the products are like 100% on you, and we're very glad that we are always, you're always guys out there to support us and to help and make this product happen. However, since I can see that since we have a lot of newcomers over here, in the chat section, guys, you're very welcome. If you're wondering what's happening over here, we're about to discuss the U.S. ADP non-farm employment change. And as you can see at the current moment, the forecast stands at 190,000. According to Bloomberg, where the prior figure stood at 119,000 respectively. So, the U.S. private sector continues to increase the pace of hiring in August despite global financial market turmoil. And the ADP report showed private payrolls increased 190K from 177,000 in July. The reading was below economists' expectation, but was in line with the growth trend of the first 7 months of the year. Furthermore, strong data from manufacturing and domestic activity show a pickup in economic activity, and economists expect ADP release will show a 191K job gain. So on Thursday, Fed Chair Janet Yellen told an audience at UMS and heard that while current inflation readings remain low, those numbers are being held down, mostly these transitory special factors. I expect that inflation will return to 2% over the next few years as the temporary factors that are currently weighing on inflation wane, provided that economic growth continues to be strong enough to complete the return to maximum employment and long-run inflation expectations remain well anchored. And Fed Yellen, who also reiterated her expectations for an initial Fed funds rate hike this year. Okay, let's move on, and I would like to share with you guys out there the expectations from top economists surveyed on the matter by Bloomberg. Here you are. Yeah, by the way, guys, yes, in the chat section, you're very welcome to share your views on the numbers that are going to come out in about very fast. Yeah, if you have any questions, also feel free to type it into the chat section. And continuing with the experts, we have the Bloomberg survey summary, where the median estimate stands at 190,000, average estimate stands at 119,000 as well, high estimate stands at 215K, and low estimate stands at 120K respectively, whereas the number of estimates this time has reached 45. And if we will continue, so the release offers the first major bit of hard data for assessing the macro profile in September, in addition to offering an early clue on how this month and shaping up the ADP report will be useful for looking ahead to Friday's official jobs report from Washington, D.C. As for today's data, forecast is relatively upbeat, projecting that private U.S. payrolls will rise by 200,000 in September, up slightly from last month's increase of 190K, but that's according to briefing.com. Consensus, the crowd looking for a solid rise, although the capital spectators econometric modeling suggests that a modestly weaker advance is a possibility. Whatever today's ADP number reveals, the news will influence expectation about the U.S. economy, vulnerability to blowback from the recent downgrade for China growth, prospects, growth concerns for China, and the close to 30% drop in Glencore shares have helped to drive bearish sentiment, noted the chief commodities analyst at SEP Markets. Today's report will provide valuable context, and those worries are translating into reality in terms of the hard data for the U.S. And guys, if you could possibly tell me how much time do I have left, it would be very nice of you. In the chat section, please. 20 seconds? Okay, thank you. So yeah, pretty much just for you to have a closer hint on what was the community members poll on the U.S. dollar Japanese
Thank you, Paulina. Hello, everybody. So for today's data release, we have the positive surprise trading strategy. Since we're anticipating the US employment change to post better figures than the forecast or in the previous month. And for the current data release, I've chosen the most common currency pair, the euro-dollar, as you can see. So we're expecting the euro to decline against the American currency and the US currency. The market sentiment for this given pair is quite bullish at 53.50%, with the euro being sold in 48.08% of all cases, and the US dollar being bought in 48.22% of all cases. Concerning the pending orders, both in the 50 and 100 pip range, the majority of them are to acquire the euro. In the 50 pip range, it's 59.04%, and in the 100 pip range, it's 53.33%. Concerning the market sentiments of other market participants, you can see that all three of them are bearish, with the RAND holding almost 58% of short positions. The Saxo Group has 66.83% of short positions, and 63% of traders in daily FX are short the euro. So that contradicts with our market sentiment, but since the euro is expected to fall, that kind of supports the overall bearish trend. If we move to the market reaction table, you can see that where we can see the market reactions for the previous 5 data releases of the non-farm employment change. For the euro-dollar, the highest reaction was 55 pips, and the smallest one was 16 pips, only 16 pips in the previous release. So if we calculate the average, we could expect a 31 pip reaction today for the given pair, and based on this reaction, we can set the take profit and stop loss levels accordingly, and I actually have them mixed up. My bad. Of course, the stop loss level should be over here, and yeah, so the stop loss level is located at 1.1240, which is close to the 200 period simple moving average and the daily pivot point. So that is a quite strong resistance, since those levels reinforce each other. In case we do see a worse than anticipated figure today, the pair might decline towards this area. And consequently, if we see improvements in the data, the euro should decline towards the approximately the take profit level at around 1.1178, and unfortunately there are no other significant levels close by. What also supports the bearish trend is that the shorter period simple moving averages are located below the longer ones. They recently crossed them to the downside, so that was a sell signal. So that also suggests that the pair will decline today. And since we've got like a minute left, I'll mention the technical indicators, which are giving us bearish signals in the 10-minute time frame, distinctly bearish in the 30-minute time frame, also bearish in the hourly, also bearish in the daily as well, neutral in the 4-hour and the weekly one, and also distinctly bearish in the monthly one. But as usual, the most important one is the 30-minute time frame, since it was updated specifically for the given data release, and it is giving us distinctly bullish signals. So that is also another sign of a possible decline of the euro with the given data release, after the given data release. And we have approximately 5 seconds left till the data is published. Right now the euro is going down as expected. Let's just wait until the data is published and see what happens. We might still not see a large reaction, since this is, oh yeah, we already see the data. It's slightly better than anticipated, but we see that the pair is muted, and that's actually not a surprise, since this data actually provides us with a small insight of the employment change data, which is going to be released on Friday. So it tends to have no reaction or a really small one. This is what we are seeing right now. No reaction. The pair has just rebounded from the 1.12 major level, well, making attempts to rebound. So I don't think there's any point in measuring the reaction, but nonetheless it's 5 pips. And yeah, I guess that sums up today's data release. And back to you, Polina.
Thanks, Michael. Yeah, once again, the actual data came out at 200,000 US ADP employment change, and we'll see what comes next. Meanwhile, I would love to pass the floor to Yaroslav and continue with the market research.
Great, thanks. So what we're going to do today during market research is that on Monday we talked about the best performing currency, that was the US dollar. Today we're going to talk about the least successful currency of the last 5 days, and which in our case is the British pound. So I'm taking leadership and trying to find the charts. They should be somewhere nearby. Okay. So the euro and New Zealand dollar, for example, on average appreciated about 1.4, 1.5%. So these two currencies were quite bullish. On the other hand, the sterling had lost about 1.5%. So it was the most bearish currency during this 5-day period. I would like to notice though that the sell-off was rather gradual, perhaps because the reasons for the sell-off were indirect. And the sell-off started just an hour after the beginning of the European trading session amid the good Eurozone manufacturing and services PMI figures. And this tendency of euro appreciating against the other currencies was only reinforced by Draghi's unwillingness to extend the quantitative easing, or perhaps he is willing to do so, but not just at this time. So here the pound already lost about 0.5%. The reaction of the market to a rate cut by the Norwegian Central Bank last Thursday was quite surprising. As it turned out, this even had more impact on the market than the US unemployment claims or even US core durable goods orders that were released the same day, but just a little bit later. And while the rate cut might have been unexpected, it was not that big, only 25 basis points, so nothing out of the ordinary, as we rarely hear that the actions of the Norwegian Central Bank have this kind of impact on the market, especially on the rest of the currencies. So we might reassess our decision not to include this currency into calculating the currency indexes for the other currencies. Meanwhile, not only the commodity currencies, but such as the loonie, for example, or the Aussie suffered some substantial losses as a result of this action, but the pound also came under some very heavy fire, and it lost about 0.5% just within 2 hours after the decision of the Norges Bank. So just to show you, I have somewhere a chart, the hourly chart of the United States dollar against the Norwegian krone. So this was quite a large change for an hour. So now on Friday, despite there being even less reasons for the sterling to move than before that, the currency again posted a large decline. And before you said that we had a higher US GDP growth than expected, which might have been the reason for this, this event does not coincide with the start of the decline in the pound. Also, the dollar closed in red on Friday, so this is highly likely to be the reason why the pound did fall. Perhaps it was the overall bearish bias the market holds currently towards the strong. This would be, I think, perhaps a little bit better explanation. Talking about this week, it seems to be a little bit better for the pound. We still see strong downward pressure and unwillingness of the pound bulls to step in and prop up the currency, at least a little bit, but performance this week so far is a little bit better than last week. So yesterday the pound fell once again, nevertheless, but this time against the background of indicators that showed accelerating growth in retail sales and also an increase in the debt levels, which in turn is positive for consumer spending. So even if the market participants are willing to sell the currency amid the positive events, it is currently very hard to imagine the pound moving north at all. For example, from a tactical perspective, there are some hopes that the pound will rebound, but with each day it seems more and more unlikely. For example, here is the monthly chart of the cable. And right now the pair is trading near the lower boundary of this emerging long-term pattern, but my base case scenario would be a close below this lower trend line at 148 against the dollar, with a follow-up decline to 140. So, and I would not rule out even a deeper decline beyond that point. So now in terms of the volatility, the market is becoming livelier, where we have the charts. Okay, and this means that more trading opportunities are to appear, and we're likely to see larger swings in the market. Some of the best examples last week and the beginning of this week were pound franc and also euro pound. The rest of the pairs were a little less active, but still on more or less decent levels. The ones that currently lag behind in terms of volatility and perhaps are not as interesting for intraday trading as the rest are pound loonie and also pound kiwi. And it seems that there is an increasing correlation between the pound and these two currencies, namely the loonie and the kiwi. So be aware of that. The volatility in those currency pairs is likely to be decreased, at least compared to the other pound crosses. So all in all, I do think that the present bearish trend of the pound might be just the beginning of an even larger decline in the longer run. The fundamentals are quite weak and do not seem to be particularly encouraging. The macroeconomic indicators do not warrant any hawkish actions or perhaps even comments, at least from my perspective. I suppose even looking only at the inflation should be enough to say this. Since February, we haven't seen an increase in the general price level of more than 0.1%, meaning plenty of slack in the economy, and that is still quite some distance away from the potential output levels. So that's for the market research. Thank you very much for listening. Have a nice day and see you on Friday. Bye.
Thank you very much, Yaroslav. And it seems that we have only one topic left for today. I would love to invite Alex on the whiteboard with the technical analysis.
Thank you, Paulina, and hello, everyone. Today I'm going to cover the trade pattern in terms of the Aussie versus Japanese yen. Second page. Okay. So as you can see on that 1 hour chart, the Aussie started its decline against the Japanese yen at September 17. The downward movement was stopped at 83. However, the price failed to rebound above the 85 level and fell below 83 again. At the moment, the currency pair is recovering from 82.80 and is ready to confirm the double bottom pattern as the price approaches to the neckline at level of 85 yen. In case the pair manages to gain a foothold above this K resistance level, we could see the rally up to 87.50, namely to the September high. However, on its way higher, the Aussie needs to break several important obstacles, including horizontal resistance at 84.37, as well as to pass the whole cluster of supplies around 85, where the neckline is reinforced by the September 25 high, weekly pivot point, and 200-hour simple moving average. At the same time, a failure to break through this resistance level will likely to force the rate to retreat back to 83 yen, where additional supports below this level are allocated at 82.12 and 81.35, represented by August low and weekly S2 respectively. In the meantime, the sentiment of the SWFX market participants is distinctly bullish, being that 72% of open positions are currently long. However, technical indicators do not retain the same bullish views on the Aussie versus the Japanese yen, and as the short-term and medium-term studies pointing just mostly neutral, while daily ones are pointing south, giving signals to sell the Aussie. So I think that is all from my side for today. Thank you for attention, and back to you, Pauline.
Thank you, Alice, and thank you everybody who participated in this webinar. Guys out there, don't forget to subscribe to our daily newsletters in case if you haven't done it yet. Community forecast gains new answers for the upcoming week, so don't forget to click on the banner and proceed to the quiz web page, fill it in, and receive additional $10 to your live account and to your webinar team, and subscribe to us on YouTube and check us on Twitter as well. And of course, traditionally, I wouldn't be me if I wouldn't mention the Sin Dating event, because it promises to be spectacular. You don't want to miss it. October 9th, it's approximately 1 week left. So click on the banner, get more details, get more information, register for the event, and wait for the best to come. Thank you very much for your time, and want to wish you a great remaining of the week. Thank you, and goodbye.